I think not right away, but I do think that we are kind of entering the next global liquidity cycle. So I think the kind of the relative monetary austerity of 2022, 2023 is kind of behind us. And now we see, we're back to money supply growth in the US and elsewhere. Um, and, I think that what's interesting is that this cut was the first one in a while that the market wasn't sure about. Usually the Fed telegraphs very clearly what they're going to do. And going into that day, the market's nearly 100% sure what they're going to do. This one, the market, even in the couple days before, it was kind of 50-50 on whether or not it'd be 25 or 50 basis points. They went with a more
Yeah.
dovish approach. The way they would frame it is one, unemployment. They don't want it to get any softer. The way they measure it, they don't really want that to worsen. And two, they would argue that even if they if they hold rates flat, but official measures of inflation decrease, then they're actually getting more hawkish over time because their real rates would be increasing. So let's say inflation's 5% and rates are 5%. If inflation falls to 3%, while they hold rates at 5%, they would argue that they're kind of gradually getting hawkish over time, even just by doing nothing. And so their approach is say, well, if we cut 25 or 50 basis points, we're still being like not accommodative. It's just that there's a lower level that we're being hawkish from. That's I think how they would describe it. Um, and I think overall that one of the challenges of fiscal dominance is, if you look at, there are periods of monetary dominance. So for example, the 70s was a period of very rapid bank lending. The baby boomers were entering their home buying years. There's faster than normal bank lending happening. That's where most of the money creation was coming from. Um, and public debt to GDP was only like 30%. And so if you raise rates super high, you can slow down that bank lending more quickly than you increase your interest expense that pours out into the economy. The problem is that in this cycle, because we're in fiscal dominance, we have 120% debt to GDP. Bank lending was not the problem this time. Bank lending is average in the United States. It's not particularly fast. And raising rates does slow down that bank lending a little bit, but it wasn't the problem in the first place. And it actually increases the deficits, which are actually the source of inflation. So interest rates don't have that quite as clear relationship with controlling inflation as we associate them with back in the 70s and 80s. And so that's part of the reason I expect these deficits to be structural, is that the Fed's kind of stuck in a no-win situation where if they keep rates high, it means the deficit keeps blowing out even more, which eventually can be inflationary again. And if they cut rates, then they can weaken the dollar. Emerging markets can get a little bit of a boom because their dollar-denominated debt weakens. They can increase their energy consumption and other things like that, and then you can get more inflationary pressures. And so either way, this is, I think, a background issue that they're going to deal with for years. I think that they're going to keep money printing, mainly to save the treasury market. So I'm not sure we'll see the fast rate of QE that we've seen in an effort to stimulate the economy. But basically, I think that whenever the treasury market becomes illiquid, they will basically go back to supporting it. So for example, the last time quantitative tightening ended was September 2019.
The Federal Reserve had been reducing its balance sheet when the repo rate spiked, drawing widespread attention to the issue. While most focused on the repo rate, a few analysts, among them the speaker at the time, pointed to an oversupply of Treasury bills as the underlying problem. Initially, the Fed responded with repo support, but it became clear they would soon need to start buying T-bills. By October, the Fed acknowledged the need to purchase T-bills, officially announcing a return to such purchases, though they avoided labeling it as quantitative easing, QE. Looking ahead to late 2025, a similar scenario seems likely. Although variables might shift, the trajectory points toward the Fed emphasizing the maintenance of ample bank reserves.
I do think the Fed's going to go back to kind of gradually increasing the base money supply by gradually increasing treasuries. And if you look at the New York Fed's projection, they already project this, but that by about 2025, they'll have a pivot where they go back to balance sheet increases. One difference that they do plan to do is they don't want to keep supporting the mortgage market. So they plan on letting the mortgage-backed securities keep maturing off their balance sheet while they do go back to treasury accumulation. So I do think that they're probably going to simplify their balance sheet, but not shrink their balance sheet beyond roughly a year, year and a half from now. Well, so we went through a period of somewhat slower economic growth and very high fiscal deficits, but also pretty tight monetary policy. And so you get a divergence between sectors depending on if they're on the receiving side of deficits or they're on the punished side of high interest rates. So if someone is say operating commercial real estate, they're being impacted by the high interest rates, but they're not really benefiting from the deficit. Whereas if someone works in healthcare or travel and leisure that a lot of retirees are going to and using those services, especially coming out of the kind of the pent-up demand of the lockdown periods. Those areas were doing fine, and tech was an area where a lot of tech companies, especially in this rally, it was not like the ARC type tech. It wasn't like the unprofitable tech. It was the profitable tech companies, and so a lot of them have more cash than debt. And the debt they do have is locked in with very low interest rates, fixed rate. And so every time the Fed increases interest rates, Google got a raise. Google just, their big cash position would get a raise, and their debt is fixed and little compared to their cash. So they were on the right side of the interest rate increases. And so basically, there's been like this almost unintuitively like a risk off rally, which is everybody said, I don't want to hold banks, I don't want to hold energy, I don't want to hold cyclicals, I want to hold tech, big monopoly like tech stocks, as well as other stocks like Costco. Costco is trading at like over 50
Yeah.
times earnings.
Yeah.
And people said, well, I want to own that because it's bulletproof.
Noting how much capital has flowed into mega-cap stocks with low earnings volatility. This trend has been amplified by enthusiasm for AI-driven companies like NVIDIA. However, the speaker believes this excitement became excessive, leading to some rotation out of these names. Profit-taking has been widespread, which seems reasonable given how these companies often experience CAPEX cycles that can become overextended. A particular challenge for NVIDIA lies in its customer base. While NVIDIA is highly profitable, many companies purchasing its GPUs are not, as they provide services while still struggling to establish sustainable business models in a rapidly evolving market, where stakeholders reassess whether the current pace of GPU purchases is truly justified.
We're going to have to increase the cost of our services, which might slow down the demand for those services in order to try to break even a little bit better. And I think one of the more interesting beneficiaries of the cycle could be emerging markets. Generally speaking, any sort of Fed rate cutting cycle is a window where they can do pretty well. The 2019 cycle was the last time there was Fed cuts from a recent high, but that was obviously heavily disrupted by the pandemic, the lockdowns, the less travel happening, energy disruptions, and so that didn't really rotate in the way that it potentially could have. But I think this cycle has a better chance of doing that rotation, where some capital gets out of the U.S. and goes to some of these beaten down and expensive emerging markets that have dollar-denominated debt at a time when the Fed is cutting interest rates and therefore easing the dollar. The short answer is I don't know, but I have a couple sub answers there. One is that by some indicators we had a recession in 2022. So again, like I mentioned before, Misery Index, which is unemployment plus inflation, that hit recession levels. Consumer sentiment hit record lows in the U.S. If you look at bank senior loan officer surveys, whenever they have a really fast tightening in their lending standards, that's historically been associated with a recession. And they had one of those throughout 2022, which is now easing. They're coming out of that. And so by kind of if you take out the fiscal deficits for a second and say what if you look at the private sector and look at the bank credit cycle, there were some recessionary variables there where it didn't show up as unemployment, and it didn't show up in real GDP. And I would say a lot of that's because we had post lockdown just changes in the economy, plus that fiscal dominance that we're in, which changes things. When we look at 2025, the question is unemployment going to keep rising? Historically, when it goes from 3.4% to 4.2%, when it has a move like that, it more often than not, it keeps going for a period of time. And that's the big concern that people have, because if you get that unemployment cycle, then people buy less and then other companies lay people off and you get that kind of vicious cycle. I don't know yet, admittedly, whether or not we're going to get that, but my base case would be that even if we get that, I do expect that the unemployment cycle will probably be less extreme than other recessions that we're used to. So I don't think it would be like 2020. I don't think it'd be like 2008. I think it'd be more like the 2001 recession, which was, it was by most indicators, it was not as severe as like the two recessions that came before it or the two recessions that came after it, the unemployment cycle, the real GDP, like year of year change. Um, so I think that recessions look a little bit different when you're in fiscal dominance, which my base case would be less disinflationary than we normally think of recessions, but also potentially a little bit less credit cycle focused and a little bit less unemployment focused, even if we do get that recession. So 2000 had higher valuations in most metrics, not all metrics than we have right now. Um, I think partially that will depend on what global capital wants to do. If global capital, which is currently really stuffed into the US market, wants to leave, then you could get that more significant bear market. Also,
Mm-hmm.
back in 2001 and 2, we didn't have fiscal dominance back then. If anything, we basically had a surplus. We were coming out of a surplus. Um, and so I think that the background is kind of like we're almost pre-stimulating before we would even go into a recession,
Mm-hmm.
which I think impacts that recession some. But also, right now when I compare equities to bonds, like let's say 10-year treasuries, um, it's not like I really want to pile out of equities and into treasuries. It's just not, neither of them are maybe super attractive. And so instead, there's some assets that are more interesting, I think, but not really the biggest assets. Um, and so I think that's the trouble that the market goes to. My base case would be less of a market decline than the post-dot-com bubble decline.
The market could enter a prolonged period of sideways choppy movement, potentially lasting for years. In real terms, this scenario would likely result in underwhelming performance. Drawing on analogies from emerging market recessions, the speaker highlighted a common pattern. Equity prices may rise in local currency terms, but decline in terms of stronger benchmarks like the dollar or gold. If the dollar itself were to face a similar situation, equities might underperform gold over the next 3 to 5 years. Even if equities manage to outperform, the margin is expected to be minimal. The speaker noted that there is already evidence of equities losing ground in gold terms, though the longevity of this trend remains uncertain. In nominal terms, the speaker anticipated modest returns, marked by a largely unremarkable and volatile market environment. However, outcomes may vary depending on the sector. Don't forget to like and subscribe, and let's keep this bull run going.